SIP or lump sum, which is a better investment strategy? We keep getting this question very often from our clients. And let me tell you, the answer is tricky. Hi, this is Dr. Mukesh Jindal, partner at Alpha Capital. In this video, I'll try to answer this question and explain you everything about SIP and lump sum. Before I answer this question, let me explain you what's the difference between a SIP strategy and a lump sum. Now, SIP is a strategy whereby every month the money gets deducted from your bank account and gets invested in a mutual fund. It could be equity mutual fund or debt mutual fund, depending on what kind of fund you are selecting. Now, generally, the SIP, also known as systematic investment plan, is recommended when an investor has a regular income, a salary is coming in a bank account, and every month there is some kind of savings and fixed amount you want to invest in stock market through a mutual fund, and you give an instruction to the fund house that every month deduct, let's say, X amount, 5,000 rupee, 10,000 rupee from the bank account, and it gets invested in the market. The advantage of SIP is that it's a very good passive strategy whereby every month money goes into the stock market. The advantage being that the entry risk gets reduced. Some months will be buying expensive, some months will be buying low. So over a period of time, SIP enables us to ensure that the cost price of our entry in stock market gets averaged out. We don't have to bother about timing the market at all. And every month, since money keeps going, over a period of time, it becomes a very good amount. So SIP is a perfect strategy if you have a regular income in the form of salary, then just opt for it. Now, the second strategy which comes is lump sum. A lot of time people get some bonus amount or a windfall, and that's where it becomes a dilemma. What should they be doing? This amount which they have lump sum, should they deploy in the stock market in one go? Or should they deploy in a staggered manner over a period of 6 months or 12 months or whatever period they decide? Now, it's not an easy question to answer. Let me explain you in which situation SIP or lump sum does better. Generally, at any point of time, market can have three possibilities. It can either go up, or it can be range bound, or it can go down, and then of course it bounces back. Now let's take each of this situation one by one. If there's a bull run, if market goes up, in this kind of scenario, the lump sum will do better. Let's say you've got a lump sum amount, you put that money in the stock market, and if market goes up, you are capturing most of the upside. Because if you will be doing systematic investment, you will be gradually buying it, and then a lot of time you'll end up buying at a much higher price and your return will be lower. So if you're confident it's a bull run, or if there's a drop in the market, there's an attractive opportunity, then lump sum is better, because we are buying at a lower price, and then when market goes up, we capture the upside. Second scenario is that market stays range bound for, let's say, 6 months, 12 months. And during this time, if you opted for SIP, then you get a similar price at the beginning of the period. So if a market is expected to be range bound or it stays range bound, then it doesn't matter whether you do lump sum or SIP. Both are going to give similar results. The third scenario is when market falls. There's some kind of correction. So if you have done lump sum, then by the end of that period, in the end of, let's say, 12 months, and if markets are down, you will have losses. But in that scenario, SIP ends up doing very well, because SIP will keep buying as market falls, and your cost of purchase will keep coming down with every correction. So SIP is a very good strategy if market is coming down. So it depends on the outlook of the investor. If they are bullish on the market, they're expecting market to go up, then lump sum is a better strategy. If they expect market to be in the range bound, then it really doesn't matter. SIP, lump sum, they all are same. But if markets are overvalued, and if they think that market will fall, then SIP is a better strategy. So again, I have left a dilemma for you to select. Now I'll tell you two important secrets about which strategy to select. See, generally what we have experienced from the data is that lump sum, most of the time it does well, because in long term the stock market always goes up and it's in bullish mode. Of course, there could be a situation whereby markets may fall for a short period of time, but in longer term it does well. So lump sum is a very strong strategy, and most of the time it should give higher return than SIP. But doing lump sum is not easy, because if you have done lump sum and if market falls, if you'll see sharp losses, then you may get hassled. For aggressive investors, lump sum can be very good. The second most important thing is that if you're confused, if you're not sure what to do, you don't know whether market is overvalued or undervalued, you can opt for 50-50 strategy, which means that if you have X amount, 50% do lump sum and balance 50% you can deploy in next 6 months to 12 months through SIP. It's a hybrid strategy, very successful strategy. You can't go wrong in this strategy, because if market goes up suddenly up, then your lump sum 50% will capture that upside, and if market goes down, then 50% of your SIP strategy will capture the bottom as well. So it's a very important strategy. Third, and the most important thing is, you also need to look at your current allocation. A lot of time new investors want to come in the market, they have a lot of money to deploy, they are confused whether they should do lump sum or SIP. Now my suggestion to them will be that if you're underexposed in equity to a great extent, then doing some meaningful lump sum may be very good, because you don't want to be out of the market. So you also need to look at asset allocation. Not a difficult thing to do. At the end of the day, SIP is always good. There could be some plus minus returns in short period, but long time it does very well. But you have big chunk of money, doing lump sum amount depending on the market valuation can be very good. So that's about it on SIP and lump sum. Thank you so much.